Welcome, everyone, to the Trust the Plan podcast. I am Jim.
And I'm Preston.
And you got us for 2 weeks in a row here. We're going to do another episode of the plan here while Nick's finishing up spring break. Came across an interesting tweet that I thought would make for a good episode. It's a case study, basically. It's another CFP that we see online who says, look how bad this financial plan was. So thought we'd run through it and talk about some of the things and see if we agree with them.
Yeah, let's dig in.
All right. So setting up this couple, mid-40s, 3 kids, good income, starting to get serious about their financial future. So they met with this guy, and he started looking at what they had going on, and a couple of things that he raised as red flags, and thought we would see if we agree. So first one was that this couple was adding $1,000 a month, not to their 401k, not to other investments, but to a whole life insurance premium. Adding money simply to whole life insurance when they didn't have a clear reason for it. They didn't have a permanent insurance need. It's not part of an estate plan. It was just something they got sold as, hey, you can put money into it and then take money out tax-free at some point.
Yeah, yikes is what I have to say.
Yeah, it's a big topic, and maybe one of these days we'll do a deeper dive into it. But at first glance, we tend to look at saving through insurance as a last resort. We want to see, we want that money to be accessible. We want money to, be able to grow at market return. When it's in a life insurance policy, we're losing rate of return because of cost of insurance and things like that. Cost of the policy and the fees within inside of it always seem to hamper investment return. So, and the other thing is committed to that. Because if he doesn't keep that up, that $1,000 a month, that $12,000 a year into this investment, at some point, it might not work anymore. Right, the insurance policy might blow up is the term that's get used a lot, and then he has to either put more money into it or you lose everything that went into it. So
yeah, there's a couple big red flags with this one. Like you were saying, there's all sorts of issues with the investments and not getting a rate of return you should be getting, but also based on what I'm hearing here, they're not maxing out their 401k, I should say, and they haven't maxed out these other vehicles. So should absolutely be taking advantage of those ones with lower fees, better investment returns, more investment options before you turn to a whole life policy. But the second big red flag is what the other CFP said is these clients had no clear reason. They couldn't explain why it was happening.
Right.
So the previous advisor sold them this life insurance policy and said, just go with it. Just trust me.
Yeah.
And there's no education being provided, no guidance being provided.
Right. But there was a big commission paid.
I'm sure there was.
All right. This next one I thought was interesting too. So they had set up an emergency fund. Good idea, right? Everybody should have an emergency fund. Well, their emergency fund was fully invested, so fully exposed to market risk, and it was invested in A shares, which is also a commission product. And an A share means that you pay the commission up front. So not only were they in a investment vehicle that can go down in value, like we've seen recently where the market's gotten hit, so now your safe money is now exposed to market risk. It's also in an investment that you paid, probably 5.5%, 6% to be in the first place.
Yeah. Yeah. So not only is there an issue of market risk with your emergency fund, what if something comes up and you need to sell and get access to that money to cover a hospital visit or, something comes up. But also these people had their emergency fund, they had their savings, and they just immediately forfeited a couple percent.
Right.
Like just down the drain.
Yeah. Yeah. That's a perfect point, right? You put this money in here because you might need to take it out soon. And if you did, well, guess what? You got 5.75% less than you had when you started because the first thing you did is pay the sales guy.
Yeah.
So I don't like it. What do you prefer? What would you prefer to put that money in?
Definitely the bank, but hopefully you're at least earning money market rates. But again, money market rates of 4% and you're not paying upfront commissions on it.
Right. And you have daily liquidity and money's accessible. So that's why sometimes everybody gets intrigued to try to earn on it. And I think it's great. And sometimes people feel pain when they're not earning on money. But you got to remember the point of an emergency fund is for emergencies. We need it to be there when we need it.
Yeah, it is. It is a little bit painful to have money just sitting there not earning as much as it could be. But how much more painful is it to invest that money, have the market work against you, and then you're like, oh my gosh, my car just broke down.
Yeah, have it not be there when you need it.
You would be so upset with yourself.
Right, right. So I agree. Not a good choice. Not a good place for an emergency fund. This next one was that this particular person had a brokerage account, which is great, but they didn't have one brokerage account. They had 6 different brokerage accounts, which seems like a lot. And there's clients that we have that have multiple brokerage accounts, but if they do, it's because each one, there's a reason why, right? So this person had 6 different brokerage accounts, all invested the exact same way, all in A-share mutual funds. So again, paying the upfront commission.
Yeah, I knew that A-share comment was coming.
Right. So had 6 different accounts, all doing the exact same thing, all paying an upfront commission on them.
Yeah, and I mean, like you were saying, I'm not against having multiple brokerage accounts if it's a scenario where this one is extra money for kids' college if needed. This one is earning money market. This one is invested more long term. But to have 6 of the exact same is a problem, one, but 2, going back to the earlier point, I would ask the client, do you know the purpose of 6?
Right.
And I'd be willing to bet the answer is no, the advisor said just go with it.
Right. Yeah, one of the red flags with that is lack of diversification, right? People think diversification, everybody knows we own a lot of different stuff. Well, just because you're owning it in a different account doesn't mean you're diversified, right? You have to actually own different things. We like to use different strategists for a reason. The reason we use multiple strategists is because they think differently. They build portfolios differently. They have different investments that they want to use. So year in and year out, it's so hard to know who's going to be the best one. But we know that if you have a lot of good ones in there, you're going to overall, average get good results.
Yeah.
So so we don't like that either. Definitely need to spread it out, not just in places, but by different management styles would be our thought with that, or at least assigning a goal to it so we know why we have it.
Right, and making sure the client also understands that goal.
Right, and if there is no different goal, then why are we making our life so complicated? Let's
Right.
consolidate. Let's put it all in one place where we, have better control of it.
Yeah. Imagine all of the money is for the same goal. And I'm just thinking of this because we're recording this a couple days after tax day, but all the accounts are for the same goal, and now you have to give your CPA 6 different 1099s.
Yeah.
That would be pretty frustrating.
Yeah, it might be the last year you work with that CPA.
Yeah.
All right, the last one is about disability insurance. We think disability insurance is important, but guess what? This client had a fantastic disability insurance policy through work, covered his needs, was going to meet the goal of what he needed it to do. Yet on top of it, he was sold a separate standalone disability insurance policy.
Yeah, I'm sensing a very strong theme here with the past advisor. A-shares, whole life insurance, disability insurance.
Right. A lot of commissions in there, right?
Yeah, I wonder how he's getting paid.
Yeah. Yeah, so the problem isn't disability insurance. It was you're insuring for a need that's not there, right? The need is already covered. There's no need to spend a lot more money out of pocket, to try to cover for a need that's already has a good plan in place.
Right. Yeah, no need for it. And I mean, this just comes back to the question all new clients ask us, and it's a fantastic question. I love that people are thinking about it, but are you a fiduciary when you work with your financial advisor? This case that we're going through is a perfect example of the other advisor clearly is not working in their best interest.
Yeah, you actually teed that up perfectly, Preston, because so this guy says just because you call yourself an advisor doesn't mean you are a financial advisor, right? It's pretty easy to actually call yourself that, which is kind of scary. But what are your credentials? Do you have a CFP? Have you done, the training you need to do that? And some of the questions he suggests asking is, of your advisors, are you a fiduciary? So well done. You got that one already checked off for us.
Yeah, I didn't even see that coming.
Second one was, do they clearly explain how they're paid? That would have probably come in handy for this guy. Paid a lot of upfront commissions, a lot of costs built in that he probably didn't know were there. Next question is, do you understand your plan and your investments, right? Why are we buying whole life insurance? Why are we buying more disability? Do we understand the plan? Do we understand, why do we have 6 accounts, brokerage accounts? Are they for different purposes, or are we trying to go the same place with them? One of the other ones, are they licensed to sell, but are they pushing product? That's kind of what it seemed like was taking place in this one. Are they just pushing product to make a commission, or are they actually building you a plan that's right for you?
Right. And that one goes along with the idea of, is your advisor's goals aligned with you, right? Like,
Yep.
financial advisors get paid, right? Like,
Not a secret.
Right. The business earns income. They have to make money somehow, but aligning those goals is really important.
Yeah. And again, Preston nailed it. Well, the last point was, have they taken the time to understand your goals? Because I think the key thing is they're your goals as the client, right? Not the advisor's goals, not what we think you should be doing, but where are you trying to go and how can we help you get there?
Yeah.
So
important.
Yeah. So anyway, I always find these case studies interesting to go through and look at it. And, this couple got a second opinion that they probably found pretty valuable. So if you or anybody needs a second opinion, we would be more than happy to help. So feel free to go to peakwm.com. You can find us on there. You can schedule there. And we're more than happy to give it a no-cost second opinion to anybody who needs one. Thanks.